Our central task, it seems to me, is to help bring such a movement into being.
Thank you. We'll move on to roughly the review, so we'll go anything else every 3 minutes.
Yes. How do you just press page down on signature, or the down arrow and up over.
Good afternoon, everyone. Well, it's nearly afternoon. It is afternoon. I'm from the windy city of Edinburgh, which would be a great place for wind turbines. I'm, I suppose, described as an economist, but I'm in reality a financial and derivatives analyst. I've worked in the city and city institutions for about 20 years, almost by accident. But I have been an amateur follower of Marx and Mandel and people like that. And I never thought I'd be able to combine my skills as a financial and derivatives analyst to my love and the understanding of market economics. And lo and behold, in the turn of this millennium, it all came together, and for the first time in my life, I thought one set of my skills were actually going to be useful to understanding this crisis. And that's what I'm going to set out today, is to give you some background to where the crisis arose, where it's developed, what basically the capitalist class is saying in terms of recovery, what it actually means for economies, and the sort of solutions that we would have to put into place to get to grips with the financial system in order to nullify it and neutralise it, and point to some green solutions that we could also put into place. And I'll try and be brief, so I've got about 50 minutes, so we'll go through relatively quickly the background. Basically, poor people in America were given mortgages. They were repackaged in various forms of derivatives, from very simple ones to very complex ones, and they were repackaged all around the world. So the Fed decided in 2006, there was a bit of a housing bubble going on. They raised interest rates. They didn't really understand the structure of these products. They didn't understand that there'd been a web of them created around the world. And the point I'd like to make, it's quite unlike 1929. The kind of speculation that we saw was limited to the US banking system. This is a global crisis of finance. We still don't really know all of the products that are outstanding around the world. As we said, the Fed put rates up only by a small amount, but because they were, the lending was to very, very poor people, their rates went up by a multiple. Suddenly defaults started happening. The value of these assets actually fell dramatically because they were valued much, much too optimistically. A whole series of financial institutions had been borrowing money on a short-term basis, which was very, very cheap, whereas longer-term money was very, very expensive to borrow. So they were borrowing on a short-term basis and lending to the rest of the world at much higher rates. Putting those rates up on the short-term basis basically froze the financial markets, and a whole load of institutions came unstuck in the first wave. I think the key thing, what's different about 1929 is that we didn't have derivatives. These derivatives range from mortgage-backed securities, almost like a bond guaranteeing a mortgage, to something we've heard of, the collateralized debt obligations. The third one, which is, I think, the next time bomb that's ticking away, is something called a credit default swap. You can buy insurance on bonds going, company bonds going bust. And that is about $70 trillion is outstanding worldwide. It was that finally brought down AIG. That was the final nail in Lehman Brothers' coffin. There's been other derivatives explosions as well, in interest rates and inflation, and you can imagine these two kind of measures of the financial system have been moving about all over the place. So you can have massive swings on the profit and loss of these positions. And the total worldwide of derivatives, and this is an estimate, is $700 trillion of exposure around the financial system. When we had the Lehman Brothers
rate on contact, that's about 20 times the 50 times the American GDP.
I'm not quite sure, but
14 trillion in American.
How much is it?
I think it's 14 trillion.
14 trillion, so that's
American
kind of,
GDP.
yeah. This is the underlying value of these derivatives. the value of them can swing about quite dramatically. So you can be in profit by, say, 10 trillion worldwide. Somebody else is losing 10 trillion, but it can swing the other way very dramatically because they're very leveraged to various financial measures. So the kind of swings, the breakdown in the financial markets a year ago, the real breakdown was a combination of a recession heading, the credit default swap market, the insurance on those bonds rocketing. AIG and other institutions all around the world, including most of the British banks, have been selling these, thinking there'll never ever be a recession, and the value of them went up massively, and they had massive hits on the balance sheets. Here we basically explain that when the financial markets had their first major shock in 2007, and it was around Bear Stearns, and it was the subprime market feeding into it. Everyone stopped lending money out because they didn't know the risks, and people still don't know what their counterparties have got on their books. And they also wanted to hold on to capital because they were having to pay out money every single day. They didn't know what the potential losses were. So that basically froze the credit markets. The big fallout in Britain was Northern Rock and HBOS. Essentially, the drying up of credit led to the recession because, and here we basically explain the Lehman's issue again. The drying up of credit basically caused the recession because I think, as Sean mentioned, there's been a massive redistribution of real wealth, earned money, from the poor to the rich. The big problem in the 70s was there was an overproduction of goods, not enough money to consume to buy those goods. One of the ways that capitalism tried to get around this was by creating huge amounts of credit, creating a private housing market. They also opened up the financial system so that money could flow around the world, and also that the money that was being overaccumulated and couldn't find a home could either go into privatized industries or could go into financial speculation. So these policies that have come to fruition in terms of a disaster, a financial and economic disaster for us, came out of policies that were started by Reagan, Thatcher, and then refined by Clinton, Bush, Blair, and Brown. So that the very policies they put into place to try and solve the crisis in the mid-70s and early 80s has led to, again, a massive problem of overproduction. At the same time, profit rates were declining in most mature industries in the West, and we've seen before this crisis broke out, they were already sharply moving down. What has happened is that capital has generally flown to the east, where there are less developed factories, there are less automation, much cheaper labour, unorganised, you can get super exploitation, and that's to counter the declining rate of profit. Even in Britain, the service sector is now showing big declines in the rate of profit. So we're going to start to see our service jobs being moved from Britain out to the Far East. We've already seen that through the outsourcing of a lot of the back office functions of financial companies and corporations. Together with the drying up of consumer and corporate credit, and the government's having to spend massive amounts of money basically to hold up the financial system, to stop the banks going insolvent, it's going to lead to a stagnating and indebted economies. That's going to be the new kind of period that we're in. We've heard about the German, France, slight green shoots of recovery. Their banking system was less polluted. They had to spend less on the banks, more for stimulus programs, and we've seen only a very slight pickup in the economies. But the banks in these two countries have big exposure to property speculation in the emerging markets, particularly in Eastern Europe. So we're likely to see big write-downs in these banks. I don't know if people, the recent G20 meeting, the big thing that came out of that was that the Americans and British are basically saying to the Europeans, you have to have the same capital requirements that we have. And they're sort of saying it's a way of controlling the financial system, but it's actually a way of trying to have a